On today's video, we're going to take a look at 3 stocks to keep an eye out for this week. So let's get started. Like I mentioned, 3 stocks for the week, and those 3 stocks are going to be Zoom, ticker CM, Crowdstrike, ticker CRWD, and Cloudflare, ticker NET. And the reason we're going to take a look at these 3 companies is they're all reporting earnings this week. And if you guys want me to do an in-depth analysis on any of their earnings, feel free to let me know in the comments, and the ones with the most comments are the ones I'm gonna do. For some reason, I feel a lot of people are gonna say Zoom, but the other 2 I believe have been trending a lot, so they might have some traction as well. Alright, so the first stock we're going to take a look at is Zoom, and Zoom right now is sitting at about $180. It ended the week at a 10% up on Friday, and after hours is actually another 1.6% and is sitting at $182. So that's actually pretty crazy. And Zoom, what it does, if you don't know, Zoom is pretty much a software video platform that is used for teleconference, telecommunication, distance education, and social relations. So obviously with the whole COVID-19, people working from home, people not being able to see their friends, Zoom has become more of a household name. Right now it's sitting at a market cap of about 50 billion. And in this episode, we're just going to take a quick overview on all these 3 stocks. We're just going to take a look at revenue growth, a quick look at their balance sheet, and then a quick look at valuation and see what analysts say about the current price. So like I said, if you guys enjoy the vid, hopefully you guys enjoy the video. And before we go any further, guys, don't forget to subscribe, hit the thumbs up and the bell. It helps the small channel out so much, and I truly appreciate it. And if you guys ever want to get in contact with me, make sure to follow me on Twitter, and I do have a Discord open to anybody, so come by and feel free to talk. Alright, so the first thing we're going to take a look at is Zoom's revenue growth, and here I'm on this amazing website, lazyfa.com. It's one of my favorite tools to use, and in 2019, for the full year of 2019, Zoom grew revenue by 88%. In 2018 compared to 2017, it grew about 118%. And in 2017 compared to 2016, it grew about 150%. And all these years have been pre-COVID-19. So I'm guessing this is why investors are driving this price up, because if it was getting revenue growth in those high double digits, and even triple digits pre-COVID-19, imagine what type of revenue growth it will see in the upcoming quarter, where it is during COVID-19. All right, next let's take a look at this company's margins. And gross margins for a company like this is 81.5% for 2019. And since this is a software company, you usually expect high gross margins. And they do seem to be growing a bit every year. Last year was also 81.5, but the year before that was 79.7, and the year before that was 79.5. So gross margins are increasing a little bit. That means that this company is getting better at using its money properly. All right, the next thing we want to take a look at is this company's profit margins. And with that type of revenue growth, I kind of expected that this company might have been in the negative profit margins. 2019 was actually the first year this company produced positive profit margins. It has been increasing every year. And this is normally what you see with growth stocks. You usually see very high gross margins, especially in the software base. And these companies right now, heavy revenue growth, they're trying to spend their money right now in growing, getting more customers. So like that, eventually they'll have enough revenue coming in where they will end up positive profit margins. And that's what happened in 2019. This company actually ended up 3.5% of GAAP profit margins. All right, so next let's take a look at this company's balance sheet. Right now, at the end of 2019, this company only had $0 in current debt and $65 million in non-current debt. And a huge portion of this company's total liability is deferred revenue. And deferred revenue, if you guys have been watching my channel, this is pretty much a fake liability to me, because it's just a liability. If you guys don't know deferred revenue, my easiest way to explain it is Netflix. Let's say you buy a year subscription of Netflix, right? But you've only are in month 1 of your subscription, even though you already paid for the full year. It has only provided you 1 month of its product. It still owes you 11 months. That other 11 months of revenue is considered deferred revenue because it has yet to provide you with that product. So that goes into deferred revenue. So eventually this would get out of deferred revenue. And for me, like I said, I consider that a fake liability. Next, let's just take a look at the most recent assets. Current investments of about 570 million and cash equivalents of about 300 million gives this gives this company close to 900 million dollars of quick cash, and that's more than enough to pay off this company's non-current debt and still have plenty of cash left over. So for me, this balance sheet is actually like a A. I normally don't give many companies a A. I usually give a B or a C, but to see a balance sheet like this is definitely an A-worthy balance sheet. Next, a quick look at this company's valuation. And this is a growth company, so I don't focus on forward PE ratio. I pretty much focus on forward price to sales ratio. For January 2022, this company is expected to make about $1.2 billion. That gives this company a forward price to sales ratio of about 40. To be honest, for me, even for me as a growth investor, that's a bit high for my taste. And again, I can understand why investors are willing to go into this stock. They see that strong revenue growth of almost triple-digit revenue growth, a very strong balance sheet, and also a very strong gross margin increase and profit margin increase. But to me, right, again, it might be a good investment to some, but to others, it might not look like one. And for me, it doesn't seem like the best investment right now. And I just wanted to take a look at Yahoo Finance. They kind of have this analyst price target, and usually I don't follow this, but I feel like maybe some of my viewers might enjoy this. Right now, about 20 analysts are estimating what Zoom should be worth, and on average right now they estimate an average of $121. Right now the current price is $179, so it's a bit overvalued compared to what the average analysts say. Again, if you listen to an analyst, that's on you. I provided with the information at first, but just to see what the overall market is saying about this stock. Alright, the second company we're going to take a look at is Crowdstrike, and Crowdstrike is a cybersecurity technology company based in California, and it provides endpoint security, threat intelligence, and cyber attack response services. And again, this is a company that has going to be doing good due to COVID-19, right? With more people working from home, more companies are dependent on their cybersecurity. So compared to February 20th, this company is up about 40%, way better than the market has done. And in just the past day, this company, similar to Zoom, was up 10.45, almost 11%. At the end of the day, sitting at $87, and after hours it actually jumped another 2.5%, sitting at $90. So this company in just the last day has had a huge run up. So this is a smaller company, a market cap of about $19 billion. So now let's jump into Lazy FA to see the revenue growth that Crowdstrike has for us. And like I said, Crowdstrike's ticker is CRWD. And like I said, if you guys want me to take a look at any of these companies with a very in-depth analysis on their earnings, make sure to post on the comments. So right now we're going to take a look at this company's revenue, and after this we'll take a look at the margins. So in the revenue, we see in 2019 it grew 92%. In 2018 it grew 110%. In 2017 it grew 125%. So this company, very similar to what we saw in Zoom, it's growing by very high double digits, and prior years even triple digit growth. Now let's take a look at this company's margins, and next we're going to take a look at the balance sheet. So the gross margins for this company are not as good as Zoom. Their recent gross margins was sitting at 70.6%. 70.6 is still pretty high, especially since this is kind of a software-based company. So 70.6 is what we expect. Throughout the years, it has been improving. In 18, it was 65, and in 17, it was 54. So right now, sitting at 70.6 definitely shows gross margins increasing. Next, profit margins. Unfortunately, this company is still losing money, but it's losing less percentage profit margins each time. Right now, profit margins are negative 30%. And to me, this company is definitely losing a big chunk right now. But in 2018, it was losing 56%. And in 2017, it was losing even more than 119%. So that's pretty insane. So to me, right, we did see strong revenue growth, but the margins is not looking as strong. And I'm pretty sure we're gonna be seeing this have a cheaper valuation price compared to Zoom. Next, let's take a look at this company's balance sheet. And after this, we'll do a quick look at the company's valuation. So right now, this company in the most recent of 2019, at the end of 2019, this company did not have any non-current debt, and it did not have any current debt. Almost over 90% of this company's liability is deferred revenue. And like I mentioned, I talked about that earlier in Zoom, what that was. So that's actually pretty impressive. I know right off the bat, this balance sheet is going to be an A to A+. This company has about, I want to say, $900 million in cash. And with no debt whatsoever, this is definitely a very, very strong balance sheet. Now let's take a look at this company's valuation. Similar to Zoom, I don't feel comfortable looking at a forward PE ratio because it doesn't tell you the full story, right? This is a company growing at a high double digits, close to triple digits in some years. So forward price to sales for 2022 is about 20. And that to me is still pretty high. Normally, I prefer something like this to be in maybe the mid-teens. Definitely not the highest. If this was in the 15th, again, to me, it does seem a little bit overvalued to my taste. But again, this doesn't mean it's not going to continue to go up. Investors right now are believing that this company will continue, and that's what's driving the price up. But a 20 forward price to sales ratio is a lot cheaper than Zoom. So it's not that crazy overly priced. I would personally prefer somewhere around the 15 forward price to sales ratio. But like I said, if you're buying this company, you're buying a super strong revenue grower, you're buying a very, very strong balance sheet, and you're buying a very good market. I believe in the market that this company is in, right? The cybersecurity is a market that will continue to go up. And again, for me, it might be a little bit overly priced. If I was to enter in a position like this, it would be just an entry position, just to have my skin in the game. But I would probably not go in the full position. And if there is a pullback, then I would continue to increase my position in there. So in Yahoo Finance, if we take a look at their valuation, 22 analysts are pretty much looking at this company, and they give it an average price of about $73. Right now, this is sitting about 87. So it's a bit higher than what analysts expect, pretty similar to Zoom. So are all these companies overvalued, or are analysts just undervaluing them right now? To be honest, I do not know the answer to that. So now let's take a look at Cloudflare and just a quick look at their stock price performance, and then we're going to take a look at revenue growth. So Cloudflare is American web infrastructure and website security company. So this did not take a big jump like we saw Zoom and Crowdstrike. And I'm guessing maybe this might be a less popular company compared to the other two. But again, another small company like Crowdstrike sitting at a market cap of about $9 billion. And if we take a look at the price performance from February 20th, this company has jumped up about 43% compared to where it was. So this has returned pretty amazing returns to its investors. So now let's take a look at this company's revenue growth, and then we're going to take a look at the margins. So revenue growth in 2019 was 48%, in 2018 it was 42%, and in 2017 it was 60%. So this company is not growing as fast as we saw Crowdstrike or Zoom, so I'm pretty sure we're going to see a lower price valuation compared to the others. Now let's take a look at margins, and then we'll take a look at this company's balance sheet. And the first thing I'd see that I don't like is this company's profit margins. Instead of going up, they seem to be decreasing. In 2019, it was about negative 37%. In 2018, it was negative 45%. In 2017, it was negative 8%. And in 16, it was negative 20%. So this company's profit margins seem to be all over the place. And that instability is something I'm not liking right off the bat. This company definitely has a lower revenue growth than the other two companies. And to be honest, right now, I'm not really a fan of net, but let's see if that balance sheet changes my mind. So now let's take a look at this company's most recent balance sheet. And right now, this company has about 33 million in non-current debt and about 17 million in current debt. So that pretty much is $50 million in debt. But look, this company has 120 million in cash and cash equivalents and 480 million in current investments. So close to $600 million in quick cash to pay off that 50 million in debt. To me, this is another A balance sheet. So all these companies have actually had an A to A plus balance sheet, and it's what you expect for a growth company. So now this company's valuation, forward price to sales ratio, is 17.23. This is a lot cheaper than we saw Zoom, and it is a lot cheap. It is a bit cheaper than Crowdstrike. But again, now for Crowdstrike, I said I would be okay paying somewhere around a 15 forward price to sales ratio. For net, I wouldn't be. I'll probably prefer to pay something even cheaper than that, because one, we saw this company had lower revenue growth than the other two. This company also had very low, their margins were all over the place, something I did not like. So for those reasons, I would value this company even cheaper, right? It's you always have to look at each company independently and see which one you would pay more for, which one would you pay less for, and understand for what reasons you would do that. So hopefully you guys see the reasons why I would even pay cheaper price than I would do for Crowdstrike. So again, this company, I do believe all these companies are a bit overpriced, but again, that does not mean that these are bad investments. These companies can continue to go up. So if I was to be bullish in any of these companies and did not have a position in them, what I would do is I would personally just open up a small starter position just to have my skin in the game. But if things go bad, I would increase my positions as they get cheaper, because I already know about the company. And if they go up, then I'm at least in the skin. My skin is in the game, so I will at least get some returns as well. Net has current right now, average has 13 analysts, which average it at $24, and right now it's sitting at $29. And again, like I mentioned, all the analysts see this a little bit overpriced, similar to me. But like I said, I would play this if I was bullish in any of them. And I actually like Crowdstrike a bit, but just because of that big jump, it's kind of scary. So that's why I would do a small entry position. So if you guys, like I said, if you guys want me to do an in-depth analysis on any of these companies, you guys might be like, hey, Jose, this was actually a lot of information. This is probably not even half the information I do before investing in a company. So if you guys think this is a lot, wait for me to show you an in-depth analysis. So feel free to let me know if you guys want me to do one on any of these companies. Like always, guys, make sure to subscribe, make sure to hit the thumbs up, and make sure to hit the bell. It helps the small channel out so much, and I truly, truly appreciate it. Good night, guys, and see you next time.